If someone asks you how do you select mutual funds, your answer should not be like choosing randomly from YouTube suggestions. It should not be random. Your hard-earned money has to reach the perfect place based on your choice. Do you know the way you select your mutual funds drastically changes your returns over a long period of time? Welcome to Eagle Finance. Let us discuss how to choose the perfect mutual fund for yourself. We'll be covering this in 2 steps. First thing first, what exactly are mutual funds? If you already know about it, comment below. They are investment vehicles that pool money from various investors to buy a diversified portfolio of stocks, bonds, or other securities. Did not get it? Let's go with an example. Let us say a hypothetical man Rakesh wanted to invest his money in equity, but he does not have knowledge on how to select the stocks. Hence, he gives his money to XYZ company to invest his money on his behalf. Similarly, XYZ company collects money from various individual investors like Rakesh. The sum of total collected money is called asset under management. This XYZ company will hire a fund manager who is expert in stock markets. He will invest collected money in 10 to 15 stocks. This pool of stocks are called portfolio. The returns from the portfolio will be shared based on the fraction of money invested. This XYZ company is called a mutual fund company. This is nothing but an equity mutual fund. Similarly, debt and hybrid mutual funds also exist. Step 2. How to select mutual fund. The main metric to check performance of a fund is return. It is not good enough to generate more returns just for 1 or 2 years. Return should be more and consistent at least for the past 1 decade. But for comparison of numbers, you can consider the last 5 years return. Assets under management (AUM) tells you how many people believe in the particular mutual fund. Hence, bigger is better. Expense ratios are so important they kill our returns badly over the long period of time. It is the fees charged by mutual fund companies to manage our money. For example, 1 lakh invested for 40 years for 15% return can become staggering 2.6 crore at 0.1% of expense ratio. Same 1 lakh becomes 1.1 crore at annual expense rate of 2.5%. Huge difference, right? Few other metrics also important. Have a look at portfolio turnover. It is how many times a fund manager changes stocks in your fund portfolio. Lower the number, better it is. Because changing the stocks in the portfolio can increase the expense ratio of the fund. Alpha is nothing but a return on top of index performance. Let us say in a year, Nifty 50 index shoot up by 12% and in the same year, XYZ mutual fund gave 15% return. Here alpha equal to 15 minus 12, 3%. Nifty 50 is the benchmark in India. Other ratios to be considered are Sharpe ratio, standard deviation, R squared and many more. Total 14 metrics are included in this Excel which helps you find out your desired mutual fund. Similar information is collected for 3 other mutual funds. You can use a money control website to collect all the information needed for comparison of mutual funds. I will add the Excel file in the description for your reference. Look beyond the numbers and understand the fund's philosophy and management. Conclusion. To sum it up, selecting the perfect mutual fund requires thorough research to align with your goals, at the same time managing risks. Are you ready to take charge of your investments? Share your thoughts in the comment below and hit that subscribe button for more financial insights. In the previous video, we discussed financial planning, for which you can find a link to an iCard or in description. Feel free to mention suggestions for future videos. Thanks for watching.